What's going on, guys? It's Jimmy here. So, we're starting to see some really significant problems with the banking system. Now, we're starting to see banks are bailing on small mortgages, pulling out of mortgages, driving buyers to risky alternatives. This also comes as foreclosures are rising towards pre pandemic levels. And nearing all-time highs. Yeah, take a look here. American banks are losing interest, consumer advocates say, in writing mortgages for inexpensive homes. Their exodus from the small mortgage markets, average everyday Americans, low and middle income Americans, leaves a patchwork of risky, poorly regulated home loan alternatives that can propel the most vulnerable buyers into debt or homelessness or higher interest rates than already is, having to find even higher rate mortgages. 20 years ago, the median home cost was less than $200,000 for a home. The banks routinely approved mortgages for half that amount. Today, the median home costs $437,000, and buyers struggle to find banks that will write mortgages for less than $150,000. Wow. Instead, many buyers turn to alternative financing, a universal personal property loans, lease purchase agreements, land contracts, and seller finance mortgages, all of which can be much more expensive. Typically, those transactions are both riskier and costlier than a mortgage, and they fall outside the regulatory cocoon that protects home buyers from fraud and trickery. In worst cases, borrowers can lose their homes and their solvency. Quote, people think that they are on the path to owning their own home when in fact they're on the path to financial disaster, forfeiting all of their money that they have paid in, as well as the place that they thought was their home. Too often, these contracts are designed to fail. Yeah, said Tina Smith, who spoke at a Senate hearing with the dramatic title, quote, Exploiting the American Dream, How Abusive Land Contracts Prey on Vulnerable Homeowners. Senator John Tester termed the industry's bad actors, saying, quote, a bunch of folks who should have a special place in hell. Yeah, this is a significant problem that's happening to a lot of people as foreclosures are rising towards pre-pandemic levels now. Right now, foreclosure activity picked up across the country in the first 6 months of this year and is moving closer to pre-pandemic levels, according to a new report. There was almost 200,000 U.S. properties with foreclosure filings just in the first half of this year, over 185,000 of them, which include default notices, scheduled auctions, or bank repossessions in just the first half of this year. This is up 13% from the same period last year and up 185% from 2 years ago when there was only slightly more than 64,000 in the first half of that year. Yikes. Quote, similar to the first half of 2022, foreclosure activity across the U.S. maintained its upward trajectory, gradually approaching pre-pandemic levels of this year. Foreclosure filings in the first 6 months of this year, with the highest numbers recorded in Illinois, New Jersey, Maryland, and the largest increases were from Maryland, Oregon, Alaska, West Virginia, and Arkansas. Yeah, let me know your thoughts on that in the comments below. And what's going to make this even worse here is we're expecting more rate hikes from the Fed going forward here. We're going to have a Fed meeting here in a few days, with possibly yet another rate hike. The other problem, as if the rate hikes weren't bad enough, is going to be how long the rates stay high. That's a double-edged sword right there because the rate hikes are really bad. It's not just for homeownership, it's for your credit cards. They're raising rates at pretty much every time that they raise rates. They raise your credit card rates. It affects your car rates. Buy a car, lease a car, used cars, new cars, personal loans, and anything having to do with interest or mortgages. It's sucking the life out of average everyday Americans, pretty much everybody, and it's getting worse and worse. And the other problem is going to be how long rates stay high. So this is really bad. This is affecting student loans. I mean, this is affecting like all walks of life here. It's affecting everybody, absolutely everybody. And this is going to go on for probably a while. This is also affecting businesses and jobs. This is why if you didn't see my video here on the Fed's warning about the next Great Depression coming, you should watch that video. I'll link you to that video here next because that's actually a really good video. It's shocking what is actually happening here with businesses and what the Fed's actual new warning about this is. Um, yeah, really good video there. It's astonishing what's happening here. Put aside stuff like mortgages and stuff. It's actually a completely different thing. So my recommendation is, if possible, pay off any high interest credit card debt if you can, or do the snowball method, which is pay off your lowest balance credit cards first. And as soon as you can, pay those off and either cut up the card or just put the card away in a safe. You can close the accounts, but if you close the accounts, your credit score will drop a little bit. So keep that in mind. But you got to have the willpower to not use the card again. But if you pay off a low balance credit card, you can pay that off, maybe in a couple months. It just depends on how low the balance is. Don't use the card again, okay? And then you can take that monthly payment that you were using on that card and then apply double payments to the next lowest balance card, okay? Because you won't have a balance on that card anymore. So you can take that monthly payment and apply that monthly payment to the next lowest balance card, and you'll be making double payments on that card. That's the snowball method. So then when you pay off the next lowest balance card, you can then make triple payments on the next lowest balance because you'll have the first paid off card, which you're no longer making payments on. And then when you pay off the second lowest balance card, you then could take two payments because you have now two paid off cards. It might take you a year to do this or something. And then you can take off those two paid off cards and apply those two payments to the third card. And that's the snowball method. Okay. So even though they might not be the highest interest cards, you take the lowest balance cards. Let's say you have a card with $500, balance or something like that. You can pay those off relatively quickly, in relative terms, right? And then don't charge them up anymore, and then just keep working them, even though they might not be the highest interest percentage wise. You get some quick wins there. You'd be like, all right, great, I've paid off this card. Then you work on paying the next card, and then you're working double payments on that, and you can see it kind of snowballs pretty quickly. You start making double and triple payments on cards, you really start to get some progress there. And I've told some people, I mentioned this a couple of times on my channel, and I've had some really great comments of people saying, this really works. I mean, it's not instant, like, it doesn't work in, 1 month, right? But once you do this for, several months, a year, right, it really starts to get some progress on this. So let me know your thoughts on this. And if you stick with the plan. It's a whole lot better than paying 20% plus interest because all that money is doing is going to the credit card companies, right? They're not your friends. So if you like this, give me a thumbs up. and subscribe to the channel. It's completely free to do so. I'll keep you up to date here with everything going on here in our country on a daily basis. And remember, the credit card companies are not your friends. Click here to see a video about banks not letting you get your cash out. And here's the video about the Fed's warning about the next Great Depression coming soon. Click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.